Good afternoon, Chandrakant. Thank you so much for your time. Uh, First of all, I'd like to get your thoughts on this valuation argument, broader market versus the larger cap universe. The argument now coming out is that the larger cap universe is much more fairly valued, and mid and small caps have run way ahead of fundamentals, and hence the tilt should be towards the large cap. Do you subscribe to this argument?
Hi, good afternoon, Ajay, and thank you so much for having me on your show. Just a small correction, my name is Chandraprakash. Uh, on your point on large cap versus mid and small cap, I also at this point in time, maybe for a short period for the next 12 months, but belong to the same camp, which says that there is reasonable valuation on the large cap side, and a part of mid caps and small caps maybe would have run beyond fundamentals for a short period of time. It needs some amount of consolidation or correction, whereas there is room for upside on large caps per se.
Right. My apologies, Chandraprakash. Chandraprakash, tell us about real estate space. I see some names in your fund. Real estate is coming out of a 10-year kind of a bear cycle. But now when we look at the numbers, when we talk to some of these real estate managements, the offtake seem to be surprising us. Do you think where is this coming from? Does it appear more structural this time?
So, rightly pointed out by you, demand is good, but the more important point about real estate today is that supply is limited. If you meet developers, the common point that we get to hear from developers today is that they have limited supply of ready-built inventory. And which is why when you look at the pipeline of new projects that developers are looking to launch over the next couple of years, it's quite high actually across cities, because they do see their inventories being low, and price realizations are moving higher. So obviously their profitability is looking better, and they are looking to launch a lot of new projects. In a way, we are likely to see a pretty high construction activity in real estate over the next couple of years from the pipeline as we see it. So yeah, more than demand, I would say supply is limited, which is leading to price improvement across the board. And I would say that this is a structural factor. It goes on for quite a few years actually. It doesn't stop in 1 or 2 years. When activity starts, price relation starts moving higher, investor appetite also starts moving in. So as of now, there was only genuine home buyers who were looking to buy real estate. We believe, or I believe, that there is opportunity for investment activity to also pick up in real estate.
Chandraprakash, what are you making of the kind of sector which feed into real estate? Home improvement, plywood companies, tile companies, some of these electrical wire companies which have more contribution coming from residential. Which part of this entire basket appears attractive on risk reward?
So actually, all parts of home improvement looks quite appealing to us or attractive to us. Whereas it's more about company specific within the sector that you choose from for your portfolio. But if you look at the general growth trends for the overall sector, I would say that the next 3-5 years looks quite interesting for the overall home improvement sector. Within our portfolios, we are more towards the plywood space and let's say ceramics and those kind of places, sanitary ware, ceramics and those places. Having said this, I think everything will do well. The other thing that you must notice, or you would have probably seen, is that in the US, there is a fairly sharp improvement in demand for India-made cables and wires. And you would have seen many of our Indian companies are benefiting from this trend. So that's an additional trigger or factor to consider for these home improvement companies listed in India.
Making a case that up till now, the top 3-4 companies in the wire and cable side, that story was the more domestic story. But going forward from here on, as we look at participating in infrastructure projects globally also, just example, the European Middle East corridor talks about exporting power. So these guys can also have a export play going forward and it has the potential to become meaningful going forward?
It is starting to already become meaningful. And yes, I would agree. I think the next couple of years or 3-4 years, it does sound practical, or it's logical to assume that exports as a percentage of total revenues will move much higher than where it is today. Obviously, domestic will also grow. So I think both angles will grow. Domestic will grow and exports will grow. Exports will marginally increase, inch up as a proportion to sales.
Right. Which part of the market looks slightly frothy or at the upper end of the valuation range where you may be at the fund level trimming some exposure?
So I would not say part of the market which is frothy, but within all market caps, whether it is large cap, mid cap, or small cap, there are individual businesses which have started to trade at much higher valuation than their own historical track record. So let's say let me give you a thought. Let's say in our capital, we've been in our funds quite overweight or very significant weight towards capital goods and industrial names. Over the last couple of years, given the stock price movement that these businesses have seen, there is a case to be made where incremental returns needs to be either on the lower side, or these businesses need to consolidate for the earnings to come up and then the next rally starts. I'm not saying the environment is, or the business environment continues to be strong, but I would say some amount of return may be preponed in maybe capital goods industrial space. Similarly, defense or railways. These are places where stock prices have gone up beyond what the immediate next couple of years earnings growth would be. So valuations do look slightly higher. So one needs to be a bit cautious. It's more about maybe the next 12, 18 months, your returns on those businesses for investors could be on the lower side. But if you take a 5, 7 year view, I think the environment continues to be.
Right. Chandraprakash, what are your thoughts on financials, particularly the PSU bank, the smaller PSU banks? They've had some good quarters, but have they really become serious investment grade from the institutional side, or is it still more retail HNI? Do you think that there is change in the quality of books of many of these lenders in the small to mid-tier PSU banks space?
So first of all, I must mention that we are in a phase of the market where there is excess liquidity among fund managers like us, or HNIs, or retail investors, or private equity, or even PMS or AIFs. And everybody is looking for ideas where you can see valuations move higher. So you tend to make higher returns if that happens. PSU banking space, and you mentioned these mid and small PSU banking space, valuations have been very high. And generally speaking, banking as a sector is the only sector in the market where we can very confidently say that valuations are on the reasonable side. There is, in fact, room for valuation re-rating. And there is tailwind on earnings, where credit cost or NPAs for the sector is on the lower side. Growth is picking up, and it just started. A couple of years of double-digit growth is what we've seen. One, fundamentals are strong. And on top of it, there are businesses in the mid and small size. It started with private banks, as you've noticed in the last 6 months. First, private banks moved higher, the mid size and small size. Even after this rise, they are still reasonably valued. Now it is probably the turn of mid size and small size PSU banks. And even today, after this rise, I would say valuations are still reasonable. They are not excessive. Most PSU banks will probably deliver 1% ROA over the next 12 to 24 months, which used to be their historical track record. And valuations are still around 0.6 to 0.8 time price to 1 year forward, which means that these are still reasonable. And I would not say that there is any irrational exuberance in that space yet.
Chandraprakash, what is your take on some of the global facing sectors like pharma, even IT? Do you think worse is in the price there? Pharma has done well, especially the large cap ones.
So on IT, first of all, I would say we need to watch out for how global growth pans out. For example, there are even enough warnings for the US and European economies to slow down further in calendar year 2024. And it will have some implications for IT spending from the developed market. So we need to watch out for their space. Having said this, most of the larger size Indian IT companies have reported in the last couple of months specifically fairly large deals, new deals. That will come in handy even if, let's say, economic environment were to turn slightly weaker. There is this large deal pipeline that these companies have. So net on balance, I'm maybe in my mind it is more neutralish. I would not be very bearish, but I would not be very bullish as well on the sector given the global macro environment. On pharmaceutical, well, every company seems to be a different sector in itself. There is no commonality per se, or very small commonality between one pharma company over the other. Where we are very optimistic on within pharmaceutical is on the pharmaceutical manufacturing CDMO space, where we have fairly decent exposure on that sector because we think that it's a multi-year scalable opportunity for Indian companies if they execute well. On the generic side, we are very choosy. We have limited names within our exposures. They are doing very well. As of now, if you've noticed, there's one drug which is Revlimid, which is boosting profitability for most of the Indian pharma names today. It is a limited time period opportunity for these companies. But beyond Revlimid, they need to add to their pipeline. We will monitor this space. As of now, as I said, we are more optimistic on the pharma manufacturing CDMO space.
Chandraprakash, thank you very much for joining us this afternoon. Look forward to interacting more going forward.